Tesla just posted record deliveries for the third quarter of 2021, shipping over 240,000 vehicles, mainly made up of Model 3 and Model Y. But Tesla also realized a five-fold increase in Model S and X deliveries over the last quarter. Later on, we're going to see what this means for the profitability of the company. But just over 2 years ago, Elon Musk was facing criticism for losing money each quarter. But then once Tesla started to be profitable, people began focusing on emissions credits being the only reason for positive net income. But now Tesla's deliveries are approaching the 1 million vehicle run rate, and the company appears to be growing into their market cap. In the third quarter, which just ended, Wall Street was expecting Tesla to deliver about 221,000 vehicles. This would be up about 10% from the previous quarter when Tesla passed the 200,000 vehicle mark for the first time in a single quarter. Even Tesla's biggest bear, Gordon Johnson, who typically likes to set his delivery expectations higher than Wall Street's consensus just so he can come on television after and tell people how Tesla missed his numbers, he has his expectations at 223,000. Tesla ended up delivering a record 240,000 cars, far above Johnson's estimates, or about 20% growth from just the prior quarter. They've also been able to do this with just their United States operations across Fremont and Giga Nevada, as well as the Giga Shanghai factory in China. Tesla has over 1 million units of capacity installed at its factories, but the facilities are not yet operating at 100% capacity, at least not in the United States, especially as they continue to ramp up Model S and X, which saw their production go to zero 2 quarters ago as Tesla shifted over to the new Plaid versions containing the latest technology. Tesla went from producing 2,300 of these new cars last quarter to almost 9,000, about 4 times higher production. This means that the ramp-up of Tesla's carbon-wrapped motors and other novel components is going quite well. Tesla also told us last quarter that Shanghai's installed annual capacity would be greater than 450,000 vehicles. While we don't yet have the September numbers out of China as of the writing of this video, Tesla delivered over 44,000 made-in-China cars in August alone and produced just over 41,000. On an annual basis, this equates to 530,000 units of production, so Tesla has been lowballing the capacity and the speed at which its Giga Shanghai is working drastically to ramp up Model 3 and Y. When the September numbers come out, it will likely be the case that Tesla's Gigafactory will be far ahead of 500,000 vehicles. Right now, there's almost a common assumption that each of Tesla's Gigafactories has a limit of 500,000 vehicles, since Fremont, Tesla's first major factory, has had trouble getting past that number, but the China factory continues to grow rapidly beyond that. Tesla built a streamlined factory in Shanghai that seems to now be surpassing the capacity of Fremont in the US. It's interesting that this factory only started delivering Model Y at the beginning of the year, so the ramp-up speed and the runway is quite impressive. Keep in mind that Tesla uses its lessons learned to improve on factory designs as it iterates over each version. Elon Musk views the factory as the actual product, not the car. With 2 gigafactories in Texas and in Germany set to come online this year or early next year, Tesla's production and deliveries will continue to expand. These new factories have a fresh slate and will take all the learnings from Giga Shanghai in order to boost quality and production. And by the way, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. ARK Invest CEO and CIO Cathie Wood has been a huge proponent of electric vehicles, and it's one of the major forces in her disruptive innovation investment philosophy. The backdrop of the industry includes supply chain issues and a lingering chip shortage. This past month, in September, it was reported that Honda sales were down 25%. In the third quarter, Stellantis saw a 19% drop and Nissan a 10% decline. Even Toyota, which we highlighted in our last video, saw its September sales fall 22%, which many people think is impossible for that to happen to Toyota. Despite this massive decline in the auto industry, Tesla managed to make a record number of vehicles, growing 73% over last year. Cathie Wood has been saying that while the chip shortage is real and is affecting the entire industry, even Tesla, there may be underlying forces at play, such as the actual shift to electric vehicles. In her latest In the Know podcast, she says that she's seeing that shipments of chips to the auto industry is much greater than production of end products. Yet the auto industry has been cutting back on production. That appears to go against the idea that the chip shortage is causing other automakers' sales to drop. Cathie Wood believes that these Tesla competitors simply have the wrong products. In our last video, for example, we highlighted that Toyota has almost no EVs in the making, and they're basically lobbying against the government to slow down the adoption of electric vehicles in order to buy time to catch up. While Toyota makes great, reliable engines and cars, and there's a lot of momentum behind their hybrid and gas-powered operations, these are the wrong products. They have 16 vehicle plants in Japan alone. Their 84-year history has entrenched them in the combustion engine industry, expanding globally and making components for ICE cars all over the world. While Toyota typically sells a massive 10 million cars per year, and so does Volkswagen, it's very difficult to right this ship given all the momentum and revenue being generated from their hybrid and gas vehicles. Changing the business plan for 100 different factories globally is a gargantuan undertaking, and so while Toyota makes great gas cars, if electric takes over the market in the years to come, only Toyota's production of electric vehicles will matter, which is basically non-existent today. Going back to Tesla's delivery numbers of 241,300, we can use this to estimate their earnings potential for when Tesla reports their third quarter results in about 3 weeks' time. The third quarter is typically the best quarter of the year for Tesla in terms of earnings. Even if they sell more cars or they have more revenue, they typically have some additional end-of-year expenses or stock-based bonuses that tend to bring down earnings in the fourth quarter. This has been the case for the past 3 or 4 years in a row, if not longer. So I expect this to be Tesla's strongest quarter unless they really crush the fourth quarter, but even then, as we saw last year, Tesla made almost $2 billion more in revenue in the fourth quarter, and yet Q3 had better earnings. For this quarter, I started by taking out about $400 million of emissions credits and then using the same price per vehicle as last quarter with the new 241,000 deliveries number. And then I add back the emissions credits, which will still be present, to get $11.7 billion, a record for automotive revenue for the company. It's also important to note that the price per car may increase because Tesla has been raising prices due to high demand and increased raw material costs, so that could be a tailwind for revenue. Additionally, Model S and X deliveries jumped from about 1,900 to over 9,000 for the quarter, almost 5 times higher as previously mentioned. The average Plaid vehicle price is well over $100,000, whereas Tesla's average vehicle price last quarter was closer to $47,000. So I'm being a bit conservative here, which I like to do, but these Plaid sales could add maybe $300 million or more of revenue. I'll touch on this again as we get to the bottom line. Overall, Tesla could make over $12 billion in automotive sales for the quarter. Again, it would be another record by a huge margin. I think more importantly, this will continue getting better over the coming quarters as the chip shortage, which has been affecting Tesla, begins to dissipate, as Elon Musk has said, and their new factories, once they start ramping, will dramatically increase revenue even further. Now in the second quarter, we saw energy generation products jump to over $800 million. The third quarter, historically at least, tends to be even better than the second, though we don't have a lot of visibility as to whether or not Tesla had to divert resources or if they had some large customer sales in the second quarter. Nonetheless, this segment has lots of demand and is still supply constrained, so an increase to $900 million seems possible. Services, I said, would hit $1 billion in revenue as the fleet continues to grow. This would give Tesla a total of $14 billion of revenue for the quarter. Wall Street seems to be sitting closer to $13 billion, and there's also some extra tailwinds as mentioned that could help Tesla do even better. For company costs, I used the same proportions as last quarter for every category, and I still said that energy generation would be just barely profitable on its own and services would still lose money. Even so, Tesla should surpass $3.5 billion in gross profit. I also increased R&D costs, which I think will rise as Tesla continues to hire more people as fast as they can. For sales, general, and admin, I think this quarter we'll see more spending due to Elon Musk saying that this will be a fairly difficult quarter in terms of deliveries. Tesla is growing their delivery network. In China, they opened their largest delivery network ever, and basically there's some growing pains which I've noticed seems to lead to increased spending that's temporary, but it still costs more to deliver more cars. Moving along, I left everything pretty much the same as last quarter. Their interest income and so forth shouldn't change too drastically. In the end, I said that Tesla could earn $1.5 billion in GAAP net income or $1.58 a share. Now this is GAAP earnings and the analysts used non-GAAP, the difference being stock-based compensation. Tesla spent about $500 million on share-based compensation last quarter, so if I take that out, I think Tesla could earn 50 cents more or about $2.08 per share. Now the analysts are forecasting $1.43 right now. Even the most bullish analyst is at $1.91. Also, Plaid Model S deliveries could kick up the earnings even more. If I add in about $50,000 in revenue across 7,000 Model S sales, assuming that a Model S costs about $50,000 more on average than a Model 3 or Y, not all of the Model S's are Plaid, but I get $2.19 per share in earnings for the quarter, which is more than 50% higher than the analyst earning estimates. For me, this feels reminiscent of the time just a few years after Apple released the iPhone, when they started to put up numbers that were $1 or $2 per share ahead of the analyst estimates. The analysts had no idea where Apple earnings would be and the earnings power of the company. I think the same is true for Tesla, where you start to see that as Tesla reaches higher volumes, the cost per vehicle comes down, and things like full self-driving capability package is software revenue for which no other automaker has ever seen anything like that before. And so it's still really the early innings, but with plans to grow vehicles by at least 50% per year, it's possible that Tesla's earnings power can be far greater than even the smartest analysts on Wall Street think. So do you think Tesla's non-GAAP earnings can surpass $2 per share for the first time? And do you agree with Cathie Wood in that other competitors are simply selling the wrong products, which could allow EV-focused companies to grab market share and be the new automotive leaders of the future? Don't forget to check out last week's The Fall of Toyota video. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that helped to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.